Hey, what's up? I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly market update with our friends at Strategas. Today, I'm thrilled to be joined by Strategas President Nicholas Bohnsack to talk all things markets. Nick, how are you doing today?
I'm well, my friend. How are you?
I'm doing really well. Thanks for asking. There's a lot going on, so let's zoom out. Start with a 30,000 foot view of the market. There's war in Ukraine. The Federal Reserve is hiking interest rates again, so there's a lot of chatter about recession picking up. However, on the other hand, the U.S. economy is quite strong. The labor market is as hot as it's been in a long time, and so there's potential for a slowdown that then sets us up for a longer cycle of prosperity. And I'm kind of just wondering where you fall in between the two camps. Where do you stand on the debate there?
This is what makes the business fun and unfun at the same time, right? Fun to the extent to which there are a lot of intellectual exercises and topics to sort of move through, and unfun to the extent to which the topics themselves bring some discomfort. Our view here is that with respect to Europe, specifically, I think some of the dislocation that will result or has already started to result from Russia's invasion of Ukraine could have a fairly lasting impact on the European and Middle Eastern economies in general, both the commodity related component of it, oil specifically, but also the agriculture related component of it. And Europe is the manufacturer of a lot of finished goods, and so those global supply chains, while important universally, are really critical for European economies in general. We have, as you know, yesterday we sort of pulled back on our allocation to international shares, specifically the developed economies, and have started to move our preference back towards U.S. domestic equities, again, still with a little bit of a value bias versus growth. But the question you asked with respect to mid-cycle slowdown and recession, it's our sense that Europe may be close to, if not in recession technically. How long that will last, obviously, is somewhat dependent on circumstances. The United States, for its part right now, probably has enough strength to carry the day, but we very rarely find ourselves in a situation where the economy could be slowing as pervasively as it is, and the Fed is entering into a tightening cycle. So that's something to clearly watch from a domestic perspective.
Yep, it's a thin line for sure. And you mentioned just there how you all are thinking about allocating to international shares and developed markets in particular, in focus with the war in Ukraine. But I want to, flip the script a little bit and talk about how you're thinking about emerging markets. We've seen a lot of volatility in China over the last few weeks, and emerging markets have a heavy weight to the Chinese economy. So you've outlined your thoughts on developed. How are you thinking about emerging markets at this point in time?
Yeah, I think the important thing for our Baird clients to appreciate is that they probably don't have a tremendous amount of exposure to emerging market equities. It's going to dominate the news flow. For folks who still read the broadsheet, it's going to be above the fold, for the better part of this year, specifically China, as you mentioned. But it doesn't really permeate our portfolios to the degree it permeates our news traffic. So that's number one, and I think we should just sort of bear that in mind. But secondly, the emerging markets have, unfortunately or not, a fair amount of exposure to the dollar and credit markets. And so when financial conditions tighten, they feel the effects of that, somewhat more acutely than domestic economies or economies who sort of denominate their debt in the house currency. So that I would say is sort of the framework. Then there's two subsections to it. The first subsection is, if the global economy is going to slow, we have to just look with some caution on the service providing emerging economies, right? They're probably going to suffer the effects more acutely, because as the globe slows, you demand less, and therefore the exports of services will also decline. The commodity related emerging markets, however, may be a little bit of a port in the storm. It's an odd thing. Our muscle memory on commodity cycles is certainly weaker than it is on credit and equity cycles as an investor class. But commodity sensitive economies and emerging markets are actually an interesting place for us. So that's sort of subset one. Subset two, which we could spend a lot longer time on, I'm sure, is China. And a lot of question marks around China. Our clients will remember last fall when Chairman Xi was really ramping up some of what are generally viewed as anti-capitalist incursions. Anti-capitalist in the Chinese sense, certainly. But one of the things that we've taken some good stock in is that a lot of the access points for emerging market equities in client portfolios, and to the extent to which they have them, had outsized share of Chinese equities. So we were very comfortable recommending actually a lower allocation to emerging markets over the past year because of some of the non-Russia, non-Ukraine related elements of the management of the Chinese economy. So it probably will at some point become an investable geography. But for us, I think the better part is to look from the sideline.
I think that's a fascinating point and a really interesting way to look at it. As we have this conversation, it's striking me that we're talking a lot about positioning and how to think about this environment, because it's kind of a dichotomy, right? That you have the domestic economy quite strong, labor market super strong, but you do have a lot of macro headwinds. And so it made me recall a theme that you all have talked about before, which is cyclical defensive. So cyclical, thinking about being exposed to that economic strength, defensive, positioning for some of those headwinds we talk about. So I wonder if you could explain the idea and then talk about how you all implement that in your portfolios.
Yeah, we try. Yeah, I mean, we come up with all these little catchphrases, but the reality is it does appear to have something in conflict one with the other. The first part is cyclical, and you make the headline point, which is the labor market in the United States remains strong. The U.S. economy remains in expansion. There continue to be identifiable organic drivers of growth that are helping the recovery sort of transition to an accelerating expansion. And while we may have some suspicion about the durability of that mechanism, there is still a pro-cyclical bias into the U.S. economy. The defensive part of the narrative, though, I think rests with this idea that because we came into this year anticipating a higher tax profile, because we came into this year anticipating a slightly more stringent regulatory profile, a lot of activity was pulled forward by corporate operators into last year, and specifically in the growth corners of the equity market, technology, communications, et cetera. And so what that leaves you is sort of a little bit of a too rich, too quick element in some of those growthy sectors, but a more value-oriented, more pro-cyclical bias in some of the things that we might generally consider late cycle or even defensive. And so that's where we want to start to transition and position the portfolio as we look out to what could be, higher probability as you started for a mid-cycle slowdown here in the United States at the end of this year or early next year.
Well, Nick, this is incredibly useful. It's a very difficult environment out there. There are a lot of things to consider. So having you talk through some of your ideas and positioning, I think is very useful for myself and for our clients. So thank you so much for the time, and I hope to talk to you again soon.
Looking forward to it. Thanks, Ross.